Ever wondered how to start investing with zero knowledge? Well, you're not alone. Many of us have been there questioning how to navigate the world of stocks, bonds, or mutual funds. But here's the thing, investing is not just for the financial whizzes or the wealthy. It's for anyone who dreams of a secure financial future. Investing is like planting a seed. It might seem small and insignificant at first, but with time, patience, and some nurturing, it can grow into a sturdy tree that provides shade and fruit. Similarly, investing can help your money grow over time, providing you with financial security and the means to achieve your dreams. The best part? You don't need to be a financial expert to start. With the right knowledge and tools, anyone can learn to invest. It's never too late or too early to start. The key is to start now. So, are you ready to take your first steps into the world of investing? Before we jump in, it's important to understand some basic investment concepts. Let's start with the term stocks. Stocks represent a share in the ownership of a company and constitute a claim on part of the company's assets and earnings. There are two main types of stock, common and preferred. Owning stocks means that you're a shareholder and you have a slice of the company's profit pie. Now let's move on to bonds. Bonds are like IOUs. When you purchase a bond, you're essentially lending money to an entity, usually a government or a corporation. In return, they promise to pay you back the full amount, plus interest over a specified period. Dividends are a portion of a company's earnings that is paid out to shareholders. Not all companies issue dividends, but those that do, provide a steady stream of income in addition to any market price changes of the shares. Capital gains are the profits you make when you sell an investment for more than you paid for it. Conversely, a capital loss occurs when you sell for less than you invested. Risk in investment refers to the possibility of losing some or all of the amounts you've invested. High-risk investments have the potential for higher returns but also for more significant losses. And what is an investment portfolio? It's a collection of different investments owned by an individual or an organization. Your portfolio can include a mix of stocks, bonds, mutual funds, and other assets, and it's designed to help spread out and manage your risk. Understanding these terms can help you make sense of the investment world. You'll be able to decipher what financial news is saying, understand reports, and converse more effectively with financial advisors or other investors. With these basic concepts, you're already ahead of many beginners. The first step in your investment journey is setting clear financial goals. Without financial goals, it's like setting sail without a map. You might have a rough idea of where you want to go, but without a clear destination, you're likely to drift aimlessly. Financial goals give your money a purpose. They act as a roadmap for your investment decisions, guiding you on how much to invest, where to invest, and for how long. They help you stay focused and disciplined in your journey, preventing you from making impulsive decisions that could derail your progress. Let's imagine you want to buy a house in 10 years. That's a financial goal. To achieve it, you might decide to invest a certain amount of money every month in a diverse portfolio of stocks and bonds. Your goal helps determine your investment strategy and keeps you on track. Remember, your goals are the compass guiding your investment journey, so set them wisely and stick to them diligently. Now that you have your financial goals, it's time to choose an investment strategy. An investment strategy is like a roadmap for your financial journey. It helps guide your decisions and keeps you focused on your goals. There are several strategies you can choose from, and the best one for you depends on your individual circumstances and risk tolerance. One popular strategy is called buy and hold. This strategy involves buying stocks or other assets and holding on to them for a long period, often many years or even decades. The idea here is that, over time, the value of these assets will increase, providing you with a return on your investment. This strategy requires patience and a long-term perspective, but it can be very effective. Another strategy is value investing. This approach involves seeking out stocks that are undervalued by the market. Value investors believe that the market often overreacts to good and bad news, causing stock prices to become temporarily inflated or deflated. By buying stocks when they're undervalued, you can potentially earn a profit when their prices eventually rebound. Then there's growth investing. Growth investors look for companies that are expected to grow at an above-average rate compared to other companies in the market. These companies might not be profitable yet, but their future potential is what makes them attractive to growth investors. No matter which strategy you choose, it's important to remember the principle of diversification. This means spreading your investments across a variety of assets, sectors, and geographic locations. Diversification can help reduce risk by ensuring that if one investment performs poorly, others in your portfolio can potentially offset the loss. Investing can seem complex, but by understanding these strategies and choosing the one that fits your goals and risk tolerance, you can navigate the financial markets with confidence. Remember, there's no one-size-fits-all strategy, and what works for one person might not work for another. It's about finding what works for you and your financial goals. Choosing the right strategy can make all the difference in your investment journey. So, how exactly do you start investing? Beginning your investment journey might seem daunting, but it's really a series of simple steps. The first of these steps is to open an investment account. Many people start with a standard brokerage account, but there are other types of accounts you can choose from, like retirement accounts or education savings accounts. It's important to research and understand the different types of accounts and their benefits before making a choice. Once you've decided on the type of account, the next step is to select an investment platform. This can be a brokerage firm, a robo-advisor, or even a mobile app. When choosing a platform, consider factors such as fees, convenience, customer service, and the platform's reputation. You'll want a platform that aligns with your investment goals and risk tolerance, and one that provides good educational resources if you're a beginner. After you've opened your account and chosen your platform, you're ready to buy your first stock or bond. But before you do, there's some homework to do. Research is key in investing. Start by understanding the basics of the stock or bond you're interested in, what the company does, its financial health, and its future prospects. Once you've done your research, it's time to make your purchase. But remember, investing isn't about making quick profits. It's about growing your wealth over time, so don't panic if your investment doesn't perform well immediately. Be patient, stay informed, and make decisions based on careful consideration rather than emotion. And lastly, always remember to diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across a variety of assets to reduce risk and increase potential returns. So there you have it, the basics of getting started with investing. It may seem complex at first, but with time, patience, and continued learning, you'll get the hang of it. And remember, every investor started exactly where you are now. Congratulations, you're now an investor. Investing doesn't stop after buying your first stock or bond. It's just the beginning of a long, potentially rewarding journey. Let's think of it as maintaining a garden. You've planted the seeds, now you need to tend to them. Regularly reviewing your investment portfolio is akin to checking on your plants, making sure they're growing healthily. Are your investments meeting your expectations? Are they aligned with your financial goals? If not, don't be afraid to prune, to make adjustments. Staying informed about market trends is like keeping an eye on the weather. You need to know when to protect your plants from a storm, or when it's an opportune time to plant more seeds. In the financial world, this could mean adapting your investment strategy based on economic forecasts or shifts in industry trends. Investing requires patience, vigilance, and a willingness to adapt. Your portfolio is a living entity, and it needs your care to prosper. Remember, investing is a journey, not a destination. Let's quickly recap what we've learned today. We've taken a journey through the world of investing, starting with an introduction that demystified the concept for us. We delved into the basic investment concepts, understanding that investing involves risk and reward, and that diversification can help mitigate that risk. We then looked at setting financial goals because knowing what you're investing for can help guide your investment decisions. We explored different investment strategies, finding that there's no one-size-fits-all approach, and that your strategy should align with your goals and risk tolerance. We also discussed how to get started with investing, emphasizing the importance of research and the value of starting small. Finally, we touched on maintaining your investments, underscoring the significance of regular reviews and adjustments as market conditions and personal circumstances change. With these steps, you're well on your way to becoming a savvy investor. Happy investing!